Hello, everyone, and welcome to today's webinar. My name is Laureen, and I will be your moderator. I work on the marketing team here at strategyforexecs.com, and I am super excited to be hosting this session today. We have a very special guest today, the man himself, Sun Wu, author of Strategy for Executives, who's going to walk us through his framework and some interesting ideas about business strategy and innovation. Sun Wu's work is based on an extensive multi-year research, which he combined with his own experience working for 2 Fortune 500 companies for the last 15 years. His findings were introduced through his book, Strategy for Executives, and through our website, strategyforexecs.com, which was exclusively created to disseminate Sun Wu's ideas and to connect executives and strategy practitioners around the world with his framework. This webinar will be available to you on our YouTube channel after the live session, and in the video description, we will add some links to download related materials, including a digital version of the book and other tools. Sun will be answering some questions at the end of the session. We are scheduled for only an hour, but if we don't get to your questions during today's session, please email us at contact@strategyforexecs.com, and we will be sure to follow up with you afterward. And last but not least, before we get to our speaker, we'd like to encourage you to share this webinar with your social networks. Strategy for Executives is a big team effort, and we would really appreciate it if you'd help us spread the word. So, without further ado, I'd like to kick things off by welcoming the one and only, the author of Strategy for Executives, Sun Wu. Sun, over to you.
Thank you, Lorraine. Good morning, everyone. My name is Sun Wu, and I'm the writer of Strategy for Executives. If you don't know what it is, Strategy for Executives is a self-contained strategy framework that explains the core concepts of a strategy from scratch so that you don't need any previous knowledge or experience. What we did is that we extracted the core ideas about strategy from the most popular frameworks developed over the last 40 years and put them all together into a unified framework. So, what I want to talk about tonight is how to propose a strategy for an organization. Let's say you get a call from a friend asking you to propose a strategy for a company. Maybe the company that he works for or a company that he knows about. Maybe you are an analyst and you want to propose a strategy for a company that you cover, right? Or maybe it's your board or your CEO asking you to propose a strategy for the organization you work for. So whatever the case, how would you answer when someone asks you to propose a strategy for an organization, right? And we're gonna go through the whole thing. So I'm gonna provide you with a framework to answer, that question. At the end of this webinar, you're gonna be able to come up with a solid strategy for any organization, right? So, but before we go and answer that, I want to ask you a more fundamental question. What is the job of a CEO? I think probably the best way to start working our way towards a solid strategy is to ask ourselves, what is the job that we have as a CEO or as a top executive of any business organization, right? So your job as a CEO is to maximize value for shareholders within a period of time. I think that pretty much summarizes your job as a business executive or as a CEO, right? It is to maximize value for your shareholders within a period of time, right? So if we can agree on that definition, that means that to be successful, you need to do two things well, right? Number one, you need to take control of your core business. So before thinking about growth or disruption or innovation or anything else, the first order of business for any executive is to take control of the core business. That means that the business is profitable and defendable, right? Your products and services are in a market position that is profitable and that you can defend, right? A business that is not profitable is not sustainable. And a business that is profitable but it's not defendable, meaning that anyone can do it, then it's also not sustainable over the long term. So what you want first is to have a core business that is profitable and that you can defend, right? That is sustainable over time. Second, you have to maximize your earnings over a period of time, right? Once you have your core business under control, now you can shift your attention to growth, and now you can talk about innovation and talk about new products and everything else, right? And you do that to maximize your earnings over the period of time of your strategy, right? So uh, we say that you want to maximize your earnings because at the end of the day, what you do is that you pick the handful of growth initiatives that you believe would make the most impact on your bottom line, right, within that period of time. So you make the selection of the things that are gonna bring the most value to you. So rather than saying, I want to grow, 10% next year or 1% more than my competitors, I think the maximization of your earnings, meaning getting the most you can out of the resources you have, should be your goal when it comes to growth. Now, you have to have a period of time as a time frame for making your strategy, right? Because having a time frame gives you some kind of benchmark, some kind of baseline to make your decisions, right? Your strategy would be different if you are planning for a 10-year period than if you were planning for only 5 years, right? So having that time frame gives you some reference to make your decisions, right? If you're planning for a longer term, for example, you can sacrifice short-term earnings in exchange for longer-term value, right? So that's why the maximization of your earnings over that period of time should be your second goal as the CEO or as a top executive of any organization. Now, if you've been in business long enough, you know one thing about strategy, right? So getting it right is one thing, but getting it done is quite another, right? So that's why to be effective as at the implementation of your strategy, you need two disciplines in your organization. Number one, you need a strategic capital allocation, right? And we're gonna get deeper into capital allocation later in this webinar. But basically, capital allocation is the management of is the management of the financial resources of the organization. It's mostly cash, but it also deals with debt and other things. So we're gonna take a closer look later in this webinar. So the other discipline that you need is strategic management, or execution as many call it, right? Because you need an operating system to make sure that your strategy is executed, that you are making the strategy happen. You cannot just come up with a strategy and believe or think or hope that it will be implemented because everybody's doing it or everybody's doing their job. That's something that you have to take control of, and you do it through the strategic management of your organization or the execution. So that means that as a CEO or as a top executive of any organization, you need three different plans to make sure that you are maximizing value for your shareholders. Number one, you need a plan for the strategic positioning of your products and services. Why? Because first you need to make sure that your business is in a market position that is profitable and defendable. And we talk a little bit more about strategic positioning later in this webinar. And second, you need a plan for the strategic growth of your organization. That's where you handpick the growth initiatives that you're going to go after, the things that you believe are going to deliver the most impact to your organization over the long run. And number three, you need a plan to make it happen. You need a plan to make sure that plan number one and plan number two are executable, that they happen, that they are actually implemented, right? That's your operating system. This is where you have your execution or strategic management and where you have your capital allocation and everything else. So we put together all these growth options into a single mind map so that you can see visually what are the different options, what are the different decisions, what are the different options when you are trying to come up with your plan for growth. And you can download this mind map from our website, and here's the URL to do so. Right now, I know you might be thinking, well, I don't think I'm gonna get a call from my CEO asking me for strategic advice, and I don't think I'm gonna get a call from anyone asking me to propose a strategy. But in the 1980s, there was a guy called Bill Stiritz, and Bill Stiritz was a middle manager in a company called Ralston Purina. It's a big company, right? You might recognize the company, but at that time, the company was looking for a new CEO, and they were interviewing, executives for the position. And some of these executives included heavy hitters from, CBS and Nestle and other, high-level executives. They actually interviewed Stiritz, and they didn't feel that Stiritz had the experience or the background for the CEO job, right? Now, what Stiritz did is that he wrote a letter to the board, uh, specifying, clarifying, proposing a strategic direction for the organization, and he proposed a plan with clear details of how he would direct the company should he become the CEO. Right? He gave specific details about this, the businesses that he would close, the businesses that he would focus on, and he was very clear about his strategic moves. And guess what? Stiritz got the CEO job, through that letter. And later, during the following 20 years, he became one of the most successful CEOs of all time, and he actually overperformed the S&P 500, I believe 3.5 times, right? So, and everything started with, Stiritz proposing a strategy for his company, right? So in every meeting that you participate, in every conversation you have in your company, in every conference call, you are given an opportunity to think strategically and propose initiatives for your organization and propose strategies. And who knows if you are pitching yourself for the CEO job in one of those conversations, right? That's why it's super important that you have a framework to come up with a strategy for any organization, right? And this is what we're gonna keep covering here. I just wanted to make the story about a guy that basically he didn't get a call from his board or from a friend, but he saw an opportunity to propose himself for the CEO job, and he went after it, and he used his insights about the industry with his knowledge about the company. He combined those into a strategy for the organization, and he got the job, and he did a great job over the next 20 years, right? So now let's dive into the core of the training. So let's start with the protection of your core business, right? So we said first you have to protect your business, then you have to think about growth, and then you have to think about making the strategy happen, right? So now we're going into part one. So how to protect your core. So through our research, and again, there was a lot of information, and if you go to the bibliography, it's in our website, and all the references and all the work that we reviewed, you'll see that this was a massive research, right? So we evaluated probably over 300 papers and books and trainings and other things. So at the end, we came up with 10 fundamental laws, 10 fundamental rules that should guide the strategy of any business, right? So let's go through them really quick. Number one, we already saw this one. The goal of any business is to find a market position that is profitable and defendable in its market of choice, right? Once you find a market that you're going to go after, you need to find that position within those markets where you can be profitable and that you can defend, right? So unless you meet those two conditions, your strategy is not going to be sustainable over time. Now, such a market position, it's only possible through differentiated products or lower relative costs, right? So those are the only two ways in which you can find a position that is profitable and defendable, right? You either need differentiated products, or you need lower relative costs, or you need some kind of combination of both, right? Now, how does that work? Well, that's rule number 3. Differentiation should translate, if well done, differentiation should translate into higher prices, higher demand, or both. And on the other hand, lower costs should translate into lower prices, higher margins, or both. So the fundamental idea here is that what you are seeking at every single time is the maximization of your profits. And at the end of the day, the profits equation only has 3 components, right? You got price, you got demand, and you have cost, right? Price times demand gives you revenues, and revenues minus costs gives you profits, right? So at the end of the day, your strategy, should try to either increase prices, give you the ability to increase prices. You do that through differentiated products, right? Or it should give you the ability to drive higher levels of demand. And how do you do that? Well, you do that through either differentiated products, once again, or lower prices. So if you really want to do it through lower prices, then you need lower costs. So that's basically what we try to explain here. So lower costs can give you the ability to either lower prices or increase your margins. But at the end of the day, that's what you want, right? If you wanna have a profitable and defendable position, you need either differentiated products or lower costs than other comparing other similar solutions, right? And differentiation or lower costs are gonna give you the ability to increase your margins, basically. Now, rule number 4: to defend your market position, you must deliver your value proposition at a lower costs than anyone else. And we won't have the time here in this webinar to get into the definition of the value proposition, but basically, what we're saying here is that whatever makes your products different, whatever makes you, be superior to other companies, you need to do that at a lower cost than anybody else. Otherwise, your market position is not going to be sustainable over the long term, right? So, rule number 5: what you compete against really is commoditization, not other companies, right? Sometimes you believe that competition is going to steal your launch, but at the end of the day, what you compete against is commoditization, right? When you have a very competitive market, what you have is companies competing for customers doing the same things. And those same things upon which they compete, they become commoditized, and meaning that customers won't be willing to pay premium prices for those anymore. I mean, who pays more for faster internet or wider teeth in toothpaste, right? Who pays more for, I don't know, memory in computers? I mean, those dimensions have been commoditized, right? So at the end of the day, what killed the ability of those companies, of those businesses to keep getting premium prices on their products was commoditization, not necessarily competition, right? So that's why we say here that what you compete against really is commoditization, not other companies. Now, rule number 6: your strategy must be a process that continually readjusts itself, right? So a strategy should not be an event. It should not be an event that happens at one time and you don't go back to it again. So it's the other way around. So your strategy, because you want to get a strategy systematically right, then you must have a system, right? And that's why a strategy must be a process, and that process should continually try to readjust itself based on changing market conditions, right? Based on the things that you see in your markets and the things that you see in your operations. That's why a strategy, it's a process, right? Now, rule number 7: cash, not profits, is the ultimate goal of a strategy, right? So at the end of the day, profits is just an estimate, right? I mean, you can't pay your bills with profits. You do that with cash, with hard cash, and hard cash is really hard to fake, right? It's difficult to fake cash, and you can't fake $1 million in a bank account, right? But profits you can fake, right? And in the book we go through multiple cases where to explain the difference. We go through multiple examples to explain the differences between profits and cash. But at the end of the day, the ultimate goal of your strategy should be to maximize cash, not necessarily profits, right? So, rule number 8: you should always, try to find ways to reduce costs, even if your market positioning is not based on low prices, right? And at the same time, you should always try to increase your revenues, even if your market position is not based on differentiation. So what we are saying here is that any business should always be looking to reduce costs and increase revenues. And if you take a closer look at Apple's strategy, they do that all the time. So they keep reducing costs, they keep optimizing and streamlining their operations, and at the same time, they keep trying to bring new ways to increase their revenues, right? So now they have, most of their revenues come from membership and recurrent payments, right? Because they've been nurturing, developing this, membership, if you will, business model through which customers just keep paying for stuff. So they've been incentivizing their developers to create apps on a membership base. Because remember, at the end of the day, Apple takes a 30% cut on all the payments you make to those developers. So Apple has been developing this ecosystem where developers keep producing more and more, membership-based business models, right? So what this rule says is that you should always be looking to optimize your earnings, either by increasing revenues or by reducing costs. Rule number 9, the design of your organization must fit your strategy, not the other way around. Many times you see companies that they develop a strategy based on the jobs, the people, the position, the executives that they have at the time, right? Okay, we have this operation, we have this, department here, and they try to develop a strategy to get the most they can out of those people, out of those positions, out of those jobs, right? It should be the other way. You should define your strategy first, and then you have to make sure that your organization is designed to support your strategy. And that also means that every time you change your strategy, you should change your organizational structure in some way, right? So, but you should not try to do it the other way around. You should not try to fit your strategy to the resources and people and jobs and assets that you have. It should be the other way. So, and finally, rule number 10 is that an execution system must be part of your strategy, right? Again, your strategy won't do its job unless you make it happen, unless you implement it, right? So that's why an execution system must be an integral, a really at the core of any strategy. You need to have a plan to make your strategy happen, right? So there are other things that can help you think about, how to have a profitable business. For example, sometimes thinking in terms of a value system can give you a better idea of how to optimize your business to extract the most from your customers, right? So this is a customer value system, right? This is an idea that ties together multiple concepts of a strategy, and I'm not going to go into each of them. I'm just going to explain briefly, right? But at the end, so what you have here at the center is a customer segment that you're tackling, right? And then you have your entire market positioning strategy, which includes decisions about, the products that you are going to design, that you're going to develop, the sales and distribution channels that you're going to use to target these customer segments, the promotion efforts that you're going to deploy, to make to sell the benefits of those products to that customer segment, and your pricing, which makes the product available to that customer segment, right? But you also have your value proposition here, where you make decisions about the product, about the profit and pricing model, and through your value proposition, what you do is that you try to increase the customer's willingness or incentive to buy your solution, right? So that's another concept at the core of your strategy. And you also have your business model. So the business model is, the way you capture value from that opportunity, right? It's pretty much your approach to capture a piece of the value that you create for customers. Your business model keeps a piece of, right? So basically, a business model is the integration of, the product you make, how you make your revenues or your profits out of those products, and how do they integrate into your value chain, into your operation, into your assets, people, and processes, right? So you need to have an optimized business model if you want to have a healthy, profitable business, right? And finally, you have a value network, which it's not my concept, of course. This is something that that I got from Clayton Christensen's work. So, and I explained, the specific sources in the book. But basically, a value network is this combination of your value chain plus your vendors and partners. So what this idea of a value system wants to highlight here is that when you want to maximize the value that you extract from your customers, you have to optimize the value system, not only one piece, right? So you have to have this entire system optimized to maximize your customers' willingness to buy and to capture the bigger piece you want, you can from that business. And you also have to integrate your vendors and your partners, and all has to work together in a very well and integrated way here, right? So because at the end of the day, what you optimize is the value system. It's not just a piece of it. If you want to extract the most value of your opportunity. Another tool that we talk about in the book is perception maps or perceptual maps, as some people call it. So basically, a perception map helps you see where your product is positioned in the minds of your target consumers with respect to other solutions, right? In this particular perception map, we are mapping the market scope, right? You go from broad to niche, and the distinctiveness or uniqueness of your product, right? That goes from low for generic products to high, right? To highly differentiated products, right? So, but basically, what these maps tell you is who your true, competitors are. In general, and this is just a generalization, the broader you go on your scope, the higher your sales volume will tend to be, right? Because you make your product appealing to a bigger segment of the market. However, the more unique and distinctive your product is, the higher the prices you are able to command, right? So that's why, Tesla or BMW here in broad differentiation, they can probably command higher prices because they have some level of uniqueness in customers' minds. And a perception map can help you see where you are in that map. And why is that important? Because if you want to keep your profitability, you need to know where you position your products in this map. I mean, in the minds of your target consumers, but you measure that through these maps, right? So this is an example. This is a fictitious example of a perception map for the beer industry, right? So you can see here where each competitor at this point in time is positioned with respect to other companies, to other incumbents in the market, right? So here, Dos Equis, for example, can see that Stella is probably a closer competitor than Coors is, right? Now, what this also helps you with is that you can say, we probably wanna be more unique and try to develop features that make our product more distinctive and command higher prices, get higher prices. Or we want to appeal to a bigger, market. So we want to move to the right on the map. So by measuring the perception in your consumer's mind, you can see, basically where you stand with respect to other companies in the same market, right? Which is at the end of the day a measure of the potential profitability that you can extract from the opportunity, right? Because you want to retain that profitability. But if you see that your position is being crowded, is being attacked by other companies, you know that there's a high potential for commoditization, and with commoditization comes a shrinkage of margins, right? So you want to be in a market position that you can defend and that makes you money. So that's why it's important. Sometimes, I mean, in some companies, the perception maps might not be applicable for some businesses, but if it is for your industry, then you should probably take a look at it, because they can really help you see where you stand and in the minds of your target consumers, and measure your ability. In some way, you can measure your ability to play with prices and demand. And finally, if you really want to have a core business under control, you need to have a good alignment between your market strategy in your operations strategy, right? So your marketing strategy is gonna, probably define on the specific market, segments that you're gonna go after, the specific features and benefits in your products, and how you're gonna, you know, uh, get those customers, how you're gonna make your products attractive to those customers. But you have to be supported by your operations strategy. And in the book, we cover the case of Tesla, right? How they had to make multiple decisions at the operational level to support their market strategy, which is very aggressive, right? So that case alone took me like 3 weeks to complete, right? Because there's not a lot of information about Tesla, and we had to get that information through people, and try to put it all together in a way that makes sense. So take a look at that case about Tesla if you get the book. So so at the end of the day, you want to have this alignment, because you want to make sure that your operations are supporting your market strategy, right? And that's what helps you uh, keep your profitability over time. Because if you see changes in the market, and you need to tweak your market strategy, your operations strategy should follow the strategy, the entire strategy. Your operations strategy should help you move directions if you need to. And this kind of alignment in combination with the perception maps is probably you know uh, uh, a good system to help you move based on how competition is behaving, right? So that's why you need this good alignment between strategy and between your market strategy and your operations strategy. Now, moving on to part two, let's talk about growth now, right? So when we talk about growth, there are multiple ways in which you can grow, right? And so our research came down to 7 different ways uh, to grow any company, any business, right? So let's go through them one by one. Number one is market penetration. That is, you sell more of your existing products and services to your existing target consumers, right? This is market penetration. This is the market share, that you probably have heard of before, right? So this is the main, or the most popular, the most known path to grow is market penetration. You want to increase market penetration. You want to increase your market share. You want to sell more of your existing products to your existing customers. Now, path number two is market development. This is about developing new markets. This is when you take your existing products onto new markets, or sell your existing, or sell your existing products into new segments within the same market, right? Let's see how I can explain that. So, if you are an oil company, let's say that you sell motor oil, right? Like you say oil for vehicles, for cars. Now, you probably want to go to a different market, and you can probably sell the same oil, which is probably kind of the same. You can sell it to the truck and the heavy machinery industry, right? So you're pretty much bringing your same product to a different market, right? Now, you can also bring your product to a different customer segment within the same market, right? So if you are a beer company, and you know that you're probably not selling enough to ladies and the female population, you can probably make your product more appealing to that specific segment, right? So within the same market, you are now making an effort to sell more of your products to a different segment. So this is what we call, we call market development, because you have to develop the market. You have to make people that are not buying, you have to make them buy, basically. Now, path number three is product improvements, right? You need to keep improving your products, right? If you really want to protect your core business, especially from business erosion, right? Because you don't want to lose customers, right? And to do that, you need to keep improving your products, right? Unless you keep improving your products, you won't be able to retain your share of the market. So this is kind of this is more than a growth path. This is a way to prevent downsizing, right? To prevent erosion of business, right? So, but you have to keep improving your products. If you think about like Procter and Gamble, they have to be improving their Tide formula all the time. If you think about Apple and those guys, they have to keep launching new features and new models and new iPhones and new things. So this product improvement is what keeps your customer base happy, and that's what's gonna help you retain those earnings, right? So path number 4, you have to develop new products. I mean, you can develop new products. It's not that you have to, but you can develop new products and services, right? So this is a different way to grow, right? You develop new products, develop new services, or add new lines of revenues through new products, right? So this is pretty much path number 4. Now, something to comment on here is like when you sell new products to your existing customers, you are in some way using your branding and your relationships with customers as some kind of distribution channel for new products, right? Think about Uber when they came up with Uber Eats, right? When they launched the app, they already had a customer base, Uber customers, and when they launched Uber Eats, I mean those customers were there, ready to download the new app, right? If you wanted to compete with Uber Eats, you would have had to develop your customer base, but because Uber already had a existing relationships with customers, they can use those relationships as a distribution channel for new products, right? So that's why sometimes the development of new products it's kind of a organic, but it's kind of a non-organic kind of growth path. But so let's keep moving here. I think we're gonna run short of time if I don't speed it up. So path number 5, revenue innovation. That means you have to find ways to increase your revenues, either through new pricing models or new business model, right? So pricing specifically can help you make your product available to other, to customer segments, to non-consumers, so people that are not buying. You can probably make your product available. In the book, we talk about this program from Rolls-Royce called Total Care, right? Where they, rather than selling the equipment, they lease the equipment to customers, right? So customers don't have to come up and pay like a big fee, upfront fee to get the Rolls-Royce products, right? But they can lease those products and they can just pay like a monthly or an annual fee based on the performance of those products. So that's just an example. I mean, you can increase your revenues by just playing around with new business models or new pricing models. So this is another healthy path to grow, right? So path number 6 is cost innovation, similar to the previous one, but this time on the cost side, right? So you can find ways to increase your earnings by reducing your costs, by streamlining your operations, by targeting inefficient uses of cash, by eliminating positions that you don't need, right? You have to. I mean, this is something that is probably the less popular growth path to growth, but it's something viable. It's just you can really have an impact on your bottom line just by checking on your costs and see how you can optimize them. And 7, you got the inorganic growth, right? Which is like leveraging other companies' assets, right? Through mergers, acquisitions, partnerships, JVs, all those things. So this is another viable path to growth as well. So at the end of the day, what you need to do is you have to go through that list and remember the mind map we put at the beginning, right? So we had all the different paths to growth, and you have to go through the list and say, which ones would deliver the most value, the most impact to my bottom line, and just pick the ones that you believe are gonna be the most more meaningful to you. So you don't have to pursue all of them. You have to pick a few, and you have to come down to a handful probably of the initiatives that are gonna deliver the most value to you. So but you have 7 different options there to choose from. So now let's talk a little bit about the creation of new products and services, right? And this is probably one of the most exciting parts of the growth plan. But to tell you the truth, innovation is really hard, and some accounts say that probably 80 to 90% of all new products fail. They are not successful, and this is the wall of shame. This is a few products that were announced by companies with bells and whistles, and at the end of the day, they didn't deliver on their promise, right? Say, these are failures of these companies. And the thing is that innovation is really hard, because it's really hard to, I wouldn't say predict the future, but it's hard to predict what's gonna work. It's hard to predict successful new products, right? Because the only reference we have is existing products, right? So how do you think forward and come with the idea of products that are successful? That's really hard to do. But the way we approach here the development of new products is by breaking down the new different, different types of new products, if you will, into 4 different categories. We call these like 4 types of innovation, right? So the first one, we already talked about it a little bit, is the linear improvement of your products, right? So if you have the perceived value of your products, and over time, you have to keep improving your products so that they are appealing to the core of your market, right? You selected this market segment to go after, and you need to make sure that you keep improving your products so that they keep being attractive and a good solution for your customers, right? Over time, your customers are going to be more demanding, probably, or they're going to need more X or more Y. So you have to make sure that your products are giving your best customers what they want, basically. So that's why you need to keep improving your products, improving your formula, improving your features, your everything. So you have to keep moving along this linear improvement line, so to keep to remain relevant in the eyes of your target consumers. But then you have the second type of innovation, what is called the low end disruption, right? These are products that enter a market with a value proposition that seems to be of lesser quality. There's probably lower performance than incumbent solutions, but these disruptions, this type of innovations, over time can get to challenge the incumbents, right? If you think about Amazon.com when it first came out, they were not like the most attractive for book buyers, right? People would prefer to go and sit down in a real bookstore. They wanted to grab a coffee and read, and probably Amazon wasn't that attractive for those customers, right? But Amazon was appealing to a different type of customers, probably customer looking for, I would say, less popular books. And they had a wider selection in Amazon. They were willing to wait a few days to get their books, right? So from the point of view of the incumbent, let's say Barnes and Noble, Borders, and others, they probably didn't see Amazon as a threat until it was, right? Basically. So, but low-end disruptions is a type of innovation where these new products focus on the needs of a more basic type of customers that would be willing to pay less. They would be happy to pay less to get less, basically, right? So these are the low-end disruptions. Now, along the same lines, you also have the high-end disruptions, right? So if you think about, FedEx, right? When they first came out with overnight delivery, they were the first ones doing, offering those services. Nobody offered overnight delivery, right? So that's what we call a high-end disruption. It's when a new product comes in offering, way more value than existing solutions, right? So some people call them radical innovations. We prefer to call them high-end disruptions because in our mind, that's what they are. Because at the end of the day, they can end up, they would end up disrupting the incumbents. And you know, if you think about Tesla, for example, some people say that Tesla is just like a linear innovation with respect to conventional vehicles, right? And other people call Tesla a high-end disruption, right? So, but I think that the concept is important because what you see here is that you have the existing products, right? And this is why this framework, I feel, is better to explain the different types of innovations, this disruption framework, right? You have the existing products, and those products are moving in a linear direction of improvement. But then you have the low end disruption, right? You have the products, these products, these companies that focus on the needs of less demanding customers. And you also have other solutions that focus on the needs of more demanding customers, right? And those two segments is where disruptions happen, and those disruptions get to challenge the incumbents over time. So, and finally, you have what we call market disruptions. So market disruptions are these products that are, in most cases, they are products that target non-consumers of a market, right? The people not consuming the products of an industry. That's where market disruptions usually happen. Is you have different types of people not consuming the products. You have the people who intentionally don't use the existing products, right? You have people that just prefer a solution from another industry, right? Or you have people who have never been considered like a potential customer for that industry, right? So if you think about Square, the company that takes credit card payments, right? That company that became famous with the small device that you insert in the audio jack of the cell phone to take payments, right? So they kind of capture pretty much non-consumers of the market, right? First, you had the small businesses that didn't want to pay the fees of conventional credit card terminal companies, right? So some small businesses didn't have enough margins to take credit cards, so they preferred not to take credit cards. So other companies, other people that that Square targeted at the beginning was people trying to send money from one person, from one person to another. So those were customers that were not considered a customer of the credit card payment industry before, right? So these market disruptions usually happen at the outskirts. They happen in around non-consumers of an industry. So if you visualize the industries as this circle in the middle, you have unsatisfied customers, right? This is where high-end disruptions and low-end disruption happen. And then you have like the non-consumers, the different types of non-consumers. So this is where normally market disruptions happen. Think about Viagra, right? Or think about the BlackBerry. When those products came out, they pretty much invented a new category of products, right? So they converted non-consumers into consumers of something, right? So that's where market disruptions happen. And in the book, we cover different ways to develop products following this framework, right? So we provide different ways to create new products by as sustaining innovation, so linear improvement, different ways to create disruptive products, and different ways to create market disruptions, right? So of course there's no formula, there's nothing we can predict here, but these are some good guidelines to help you in the development of new products, right? So what we recommend is to have a portfolio of innovations that kick in every couple of years, right? This is a fictitious map, of course, but ideally you would end up with a portfolio of innovations where you have different types of innovations and bringing in products that hit the market at different points in time in the future, right? But at the end of the day, what you want is to keep your innovation engine always running, right? This is what you want. You want to keep the entire process, always moving your entire innovation pipeline, always bringing, ideas from the exploration phase to the selection and then to development and then to commercialization and, you know, uh, have some feedback from the market, improving your future projects and everything. So at the end of the day, this is what you want. This is what you want to have a process, you know, to capture ideas and bring those ideas, filter them and bring them to market, right? So that's it for the growth and the innovation part. So I think we are ready to move on to part three, right? How to make a strategy happen, right? And here, if you remember from our initial conversation, we said that you needed two things to make, your strategy happen. First, you need strategic capital allocation, and the other one was execution, which we're gonna see after this, right? So, but basically, a strategic capital allocation is, an strategic usage of your financial resources, the financial resources of the organization. So, at the end of the day, you only have five different ways to you know to get cash, to raise money in an organization. You can either use the company's cash flow, right? You can raise new debt, you can issue new shares, you can sell some of your assets, or you can use any kind of reserve accounts, right? Like pension funds, or in insurance companies, it is very popular that they use floats, the money that their customers pay, waiting to be paid out on insurance claims. Those funds are sitting somewhere, in a bank account, right? So some investors, Warren Buffett among them, are famous for using those insurance floats to invest in businesses, right? So at the same time, there are only five ways you can use that money. You can use it to grow your business, or put it back into the business. You can use it to pay down debt. You can buy other companies. You can repurchase your own stock, or you can pay dividends, right? So that's the only way you can use, your money, right? So that combination of options is what we call the capital allocation toolkit, right? Those are the only levers that a CEO has to manage the financial resources of an organization, right? And one way to think about capital allocation is that, and again, we provide an appendix on the book with a review of all the financial information and a review of financial statements. If you need a refresh on financial statements and some of the most basic, metrics. But so if you want to think about capital allocation, two companies with the same operating profit are going to end up with entirely different cash flow based on capital allocation practices, right? So a guy with a CEO with a better capital allocation practice would over time have a higher free cash flow, or FCF, right? So and again, I don't want to get too technical here, but we explain all of this. But believe me, if you want to be a really outstanding, a really value creating CEO, you need to understand capital allocation. Capital allocation is like it's like knowing about this is like a mechanics of companies, right? You can fix companies just by working out of their financial statements, right? So it is really important that you understand this, and we provide an entire chapter on capital allocation, and we explain all of these ideas and concepts, and we develop some formulas to track the performance of your organization, right? So one question that comes up all the time is like, how do you measure your strategy, right, financially? What would be the right metric for your strategy financially? This is something that comes up all the time as we talk about capital allocation, right? So we propose something. We propose to use free cash flow per share, and we break it down into its different components so that what levers you need to act upon when trying to increase your that metric, free cash flow per share. And this is what you should do with any metric. Any metric that you use to measure your strategy, you should break it down into its underlying drivers, so that you know how to move it up, or how to make it better, right? In this case, you know that you have to make revenues go up and costs go down to make your metric, in this case free cash flow per share, to work. And again, this is the formula for free cash flow. So, but this is all explained in the book. And if you go to our website, you can also find in the glossary section, you can find an entire section just dedicated to explain, the financial statements and the financial metrics, the most popular anyway. So, a final idea about capital allocation is that of a cash factory. If you work for a corporation and that corporation owns multiple business units, right? Each of those business units needs its own strategy. They need to have their own strategy because those business units are operating in different markets, and they face different forces, different types of competitions, different things. So each of those businesses must have its own strategy. However, there's one exception to that rule. Capital allocation should be done at the centralized level. It should be done from the headquarters. That means that the free cash flow that those companies produce, it should be sent to the headquarters for centralization, right? It doesn't mean to actually wire the money, right? But it means that giving control to the headquarters to control that, because and this is a concept that we call the cash factory, because at the end of the day, each business is seen from the headquarters as a cash generating machine, basically. And that's what they do. If one of the machines break, you just turn it down, you sell it, you close it, you fix it, and just get another one, basically, right? So that's from the central level. And but when you see everything as this cash factory, where the CEO sits at the headquarters, you see how you can cross subsidize businesses, right? You can move cash from a business that is in a mature industry, and move that cash into a business that's in a growth industry, right? So you can do all these optimizations of the uses of of how you use cash, by having a centralized cash operation, right? And if you go to the best performing companies, or corporations, I should say, companies that own multiple businesses, in most cases, they're going to have a centralized management of their cash. And this works. So believe me. So this is, I've seen this many times, and all companies I've worked for, they have a centralized, management of cash. Now, really quick, how do you evaluate new project opportunities? And this is as we close the capital allocation in the financial section. So when you are presented with an opportunity to invest in a new project, how do you evaluate that opportunity? There are multiple angles. There are different views, different lenses through which you can see the project when you are evaluating it. So I just wanted to give you like a quick framework to evaluate new project opportunities. So let's say that you are given an opportunity to invest in a new factory, in a new plant, or in a new product division, in a new business. So how do you go about evaluating those opportunities? So in our view, there are a few different plans that you need in place, or a few different chapters, if you will, that you need to evaluate, that you need to consider, that you need to explore, that you need to analyze when evaluating a new project opportunity. The first one is marketing and positioning, right? If that factory, of that project, or that business is going to make products, or is going to produce something, so you have to see their marketing and positioning strategy, right? I mean, where are those products going to be sold, at what prices, what other products are they going to compete against, what's going to be the positioning strategy, right? So you need to understand the market strategy behind that project, right? This is super important, because from here you're going to get demand forecasts, you're going to get pricing options, you're going to get inventory rotation, you're going to get a lot of things that are going to be used later in the financial evaluation, right? Which is the last one of these different chapters, right? So, but when you are evaluating a new project, this is the place to start. You need to understand the project's marketing and positioning strategy, right? Next, you move on to the technical part, right? So if it's a project that needs infrastructure, okay, what kind of infrastructure that's going to be? What kind of technology you're going to use? What's the size of the facility? Where's the location if you need physical locations, right? What's going to be the expansion program? What's going to be the performance metrics? So uh, let's say you want to build new data centers, right? So what is the optimal location, the optimal size, the optimal technology, the technology platform, how that's going to integrate with other technologies? I mean, there is a technical side that you need to explore on every single project that you invest on. Now, moving on, you also have to check the organizational matter, right? What kind of people you need, what kind of skills you're going to need. I mean, in terms of labor, quantity and quality matters, right? So if you select a location, are you going to be able to get the skills you need at that location, right? Like for me, I deal a lot with vertical farms, right? So in some places you just can't build a vertical farm. You need 120 people, you need 100 people. Sometimes you don't get the skills, you don't get the labor, or you don't get the labor at the price you need it. That's another problem that we face many times, right? So when you're thinking about a new project, you need to understand what's the organizational structure. Well, what's that? How many managers you're going to need, how many shifts. You need to make all those decisions about how you can optimize this project from an organizational point of view. Now, legal as well. What is the best, I would say, legal entity to use for the project? Are there any, tax incentives or, any other government incentives that we can apply for the project, right? What is the best legal structure of the project? I mean, there is a legal side. I mean, and you need to consider it when you are thinking about a new project. Now, project with big infrastructure, let's say, power plants or a dam or, whatever, a bridge. You need to consider the social and environmental impact of those projects in the community surrounding, the project. So do you need an outreach program? Do you need stakeholders management program? Do you need, to talk to the communities? Do you need budget to make, investments on those communities? Do you need programs to train people? Do you need, you need to consider the social and environmental impact of infrastructure projects. This is super important, and especially big projects, right? Now, you also have to see the implementation. How are you gonna ensure the implementation of your project? This is what usually most people would call this a project management, right? This is where you come with budget for all the activities, with a Gantt chart, the schedule, everything. How are you gonna make sure that the project is implemented? And how much time it's gonna get, how much money it's gonna get, how many people you're gonna need to make sure it is implemented, and all that. So this is pretty much the execution strategy of the project, if you will. And finally, you got the financial, right? All of the previous chapters are gonna give you a budget, from marketing, social and environmental, implementation, legal, organizational, technical. All of those are gonna produce some tables with with costs, and capex and opex and operational expenses, capital expenses. They're gonna produce a lot of information, demand forecasts. They're gonna produce a lot of things that you're gonna plug into your financial model, right? And then you have to do a financial analysis. More than an analysis, you need to make a financial optimization, right? Because you need to make sure that you are optimizing your taxes, your debt, all of the financial stuff needs to be optimized to make sure that you are getting the most returns out of your investment, right? So you put all that together, you get this feasibility report with each of the things that we review become like a chapter of that feasibility report, right? But in my view, and believe me, I've been evaluating projects like my entire life, new projects. This is how you make a project feasible. So more than seeing this like a feasibility analysis, you should see it as a feasibility strategy where you, rather than measuring the feasibility of a project, you make it feasible. You make the project possible, feasible, profitable, right? So those are just a few ideas about how to evaluate new project opportunities. Now, heading towards the end now, strategic management or execution, as many people call it, right? So you need an execution system, and you need to implement your strategy. You need to make your strategy happen if you really want the benefits of that strategy. Otherwise, you won't get it. So we came up with an execution system, right? Uh, More than a sequence of steps. What we look for here is like, a continual. It's like a closed loop of these different activities. So there are different. These activities need to be always, happening, always being executed if you really want to implement your strategy successful. So I'm gonna review them briefly because I don't think we have more time now. So the first thing you have to do, you need to challenge your strategy, right? So you need to, uh, pretty much understand. I mean, what inputs went in to develop this strategy? Are those inputs reliable, right? So you also need to make decisions about the things that you are not gonna do. Basically, I mean, a strategy is also about the things that you will not do. If you say that you will not compete on price, then you will not compete on price. If you say that you will not try to compete with the leader or with the big guy, then you will not do it. At the end of the day, unless you clarify, make clear the things that you are not gonna do, you don't have a strategy, right? You also have to plan for different scenario, probably, right? So you need, what if this doesn't go as expected? What is your course of action? What are you gonna do, right? So this is how you challenge your strategy. So you shouldn't take your strategy as a given, right? You have to think that your strategy was made based on some assumptions. How reliable are those assumptions? You have to really give those assumptions a reality check, right? So this is how you challenge your strategy. So from the strategy, then you have to extract your strategic priorities, right? So you have to say clearly what you want. So a priority is not something like, okay, increase customer service or increase sales. No, you need to be more specific, and here the smart way of setting goals, like, your goals should be specific, measurable, achievable, results oriented, and time based. It applies very well, right? So you need to define what are your priorities, and you shouldn't have more than just a few, right? A strategic priority might be, increase sales, 20% by, the end of 2019. It's got to be specific how much you want by when you want it, and even if you can specify the people that are going to do it, but you need to make sure that you know what your priorities are, because you need to work on your priorities every single day, right? Now the next step in the execution system is that you need to close the execution gap, and this is really important, right? When you say, I want to increase sales by 20%, 20% by the end of 2019, or that by the end of 2021, for example, you need to think about how am I going to do that? Do we have the people to do that? Do we need new branches? Do we need new plants? Do we need new stores? Do we need, how many people we need? Do we have the people for that? You need to really check whether you have what it takes to achieve those goals, right? So this is how you close the execution gap. You go and see what it takes, and you go and check, do you have it, right? And if not, you either close the gap or you go back and redefine your goals, right? But no strategy, no company can be successful, or no strategy can be successful unless you take control of, unless you measure your ability to execute it. And this is critical. You need to understand. Sometimes you might say, I want to do this, but you don't have what it takes. You don't have the people. You don't have the skills. You don't have the resources. You don't have the money. Yeah, you might say that you wanna make a few acquisitions, but do you have the money for that? Or is the money you get cheap enough for you to pull that off? I mean, who's gonna back you up on that? So you need to understand your company's ability to execute the strategy and try to close the gap. Now, you should also work through lead levers, right? This is another important concept here. So when you work through lead levers, and probably the best example to explain a lead lever is weight loss. so that you understand it more easily, right? So if you want a weight loss, you have two ways to measure your progress, right? Number one, you can wait. You can start on a diet and wait 1 2 weeks, and then you go and measure your weight at the end of the 2 weeks, and you can see whether you lost, some pounds or not. The other way to do it is through a lead metric, right? Where you say, okay, rather than, getting into a diet and waiting 2 weeks to see how well I did, I'm just gonna count the calories that I eat. I'm just gonna count, the hours of exercise that I do every week. So rather than, having a metric that's measured at the end of the period, what you do is that you have different metrics that track your effort towards the goal, right? And that's what lead levers do, right? And we give you, a number of examples in the book, but basically, once you have your goals and, once you know that you can execute your strategy, you have to create, some lead levers, some lead metrics that can help you track your work, your progress, your contribution to that goal. So if you think about the free cash flow per share that we talked about before, you remember that we broke it down into the underlying variables. Now you can define different metrics, that you can act upon to move those drivers, and so that they can move your metric in the right direction, right? So that's the goal when you set your lead metric. You want to have some metrics that can help you track the work that you are doing towards your goal, and that's what you want to do, right? So that's how lead levers work. Now, moving on, you also have to align your organization for execution, right? For the execution of your strategy. That means that you have to communicate the strategy whenever you can. You have to provide people the tool to do their jobs. You have to help them do their job. You have to, make sure that your reward system is in line with the personal interests of the people in charge of executing the strategy. That's, you need to align your organization, your organization's goals with your people's goals, basically. So you need to communicate the strategy. Now, finally, you need to execute and follow through. So this is pretty much, you need to make sure that all of these pieces, are always happening. This is not a sequential series of steps. This is a system, a closed loop where, every single task is always happening, right? And when I say you execute and follow through, what I'm saying is that you continually challenge the strategy. You continually validate your priorities. You continually ensure that your people is capable, that you have what it takes to execute the strategy, that you are closing the execution gap, that you keep track of lead indicators, that you ensure the proper reward systems and alignment of your people and their goals and your goals, and that you manage the machine all the time, that you are insisting on the realism of your plans, right? Because execution is all about realism, right? You need to be realistic. This is what strategy is okay, how realistic is this? Can I do it? How can I do it? Who's gonna do it? Can they do it? How can I help them do it? This is what execution is all about. So stakeholders management is something that can also help you execute your strategy. So if you think about it, there are, many groups of people that are in indirect, relationship through one way or another with the organization. So where if you succeed, they succeed, right? And but there are other people, and you need to manage the expectations of those people. You need to manage the expectations of your vendors and your partners and your customers. But there are other people whose expectations you also have to manage, right? Those are like external stakeholders, right? So this is why it's helpful to break down all the potential stakeholders into those two groups, right? You have your primary stakeholders and your non-primary stakeholders, and that you also have some kind of a program to make sure, or system to make sure, that you are always managing the expectations of your stakeholders. This is really important, especially for public companies, right? Where you have to manage the expectations of your investors, the investor community. Super important that you keep those expectations in line, right? So something that I usually do, something that I, became a common user of is, I map the stakeholders in my markets. So in my case, I've had to oversee multiple markets and at different points in time, and I need to keep track of who's connected to who, right? I normally come up with some kind of mind map where I map the different stakeholders, right? I have like the different companies that are involved in my deal or in my execution or whatever, and then I break that down into different divisions and departments, and then I'm not showing that here, but I also make like connections between, here I would connect David to Mary here if they have you know some connection in some way, if they are friends or if they used to work together before. Or I would make a connection here between Jeff and John here, if John always looks for Jeff's validation before signing a contract. So having those relationships mapped out can really help you, improve the execution of your strategy, especially when that execution depends on, external stakeholders, like government, regulators, and other entities. So at the end of the day, what you are handed over when you become the CEO of an organization is the organization's operating system, right? It's the entire company system where you have an structure and governance, you have culture, beliefs and behaviors, you have performance and reward system, you have the value chain, your people, processes, systems, and assets, and this is what you are handed over. You have to, tweak it and change it and manage it in a way that produces the most, right? So, and we cover all of these concepts in the book and in more detail, and we covered the corporate governance, we cover culture, like the components of culture, how can you make the culture that you want. We cover the performance system, the talent management system, how you can, align your reward system. We keep the value chain and all those concepts, and those ideas are all covered in the book. And did I mention that the book is free? I don't know if I mentioned that. So the book is free. It's free to download. You can go to our website. This is the URL. You can go strategyforexecs.com/free, and you can download it for free. So there's nothing to buy here. So just go and you put your email and we send you the digital file with the book, and go to our website. You're also going to find a lot of additional information. You're going to find other strategy tools. You're going to find a strategy glossary. You're going to find some articles about strategy and some other things. So we would love to hear from you. So this is how you can get support from us. You can also give us feedback. So we have our website, strategyforexecs.com. If you want to provide us feedback, this is how you do it. If you want to talk to me, let's say that you are stuck in the implementation of these ideas, you can send me an email. This is my email here, son at strategyforexecs.com. You can also chat with me. So just use at your discretion, right? So I'm normally not available all the time, but you can chat with me. If you have a Gmail account, you can use this Gmail account, and you can chat with me through Google Hangouts. So, and we hope that you stay in touch, right? So we are in Twitter and on LinkedIn. Just find us there. Strategy for Executives. That's how you found us here. So I don't know if we have any questions, Lori. So do we have any questions?
Yes, we do have a few questions. But just so you know, we are way over the 1 hour limit, so we will only take 1 or 2 questions and then follow up with the rest over email. The first question is, and this is one we get the most, I looked at your website and I see a great deal of content and tools there available, and I also see that your book is free to download. What's the catch?
Well, there's no catch, so there's nothing to buy here. Again, so Strategy for Executives is I would say it's a team effort. I've been working on it for many years. So this was a system that I started out as a personal project for me, and to help my own work. It became a massive effort. So just the manuscript took us 2 years to get right. I rewrote it 3 times. This was the third trial, and then with the editor, I kept, finding new things I wanted to say in a different way. It was a whole mess. So I don't think I will ever write another book again. However, I'm committed to keep this one always updated with the feedback I get from the readers, from our communities, and from your listeners as well. So um, there's nothing to buy. There's nothing, we're not going to sell you anything. So my business model, or our business model with this, is going to be, around workshops where, we offer like a 1 day workshop in-house for companies where we go and, explain these ideas and provide a framework for strategy, and this is set. So, but, readers should never be worried that we're going to sell them something. So you can go to our website, learn as much as you can. You can go and try to implement it, after you read the book. And if you get stuck, you can get back to me, send me an email, chat with me, and, help me get it better if you find some errors that need to be fixed, or that, if you find anything that would improve, future versions. Let me know. I really want to hear about it. So at the end, I want to make this the most, this book, this framework, the most comprehensive, strategy system, and the only one that people would need, right? I mean, in most cases, I mean, people would be buying new books about the same subject, and the more they learn, the least they know about it. So I don't want that to be, a strategy. So I just want people to have one system and learn it from that system, right? And it's always going to be free. So what I recommend is that rather than putting this book away after you read it, you read it, you go implement it, get in touch with me if you need to, then go back and read it again when new editions come out, or when you need to refresh those ideas, right? Don't go and read another strategy book. That would ruin it for you. So just, think about this as some kind of software that you need to update into your mind every year. So you read it, wait for future versions, get back to it, read it again, get in touch with me, go, share with us what you think. We're pretty open. So this is different from the way most people will try to sell you something, but it's not our case. We are not trying to sell anything. So
Great. Let's take only one more question since we are over the time limit. Please, if you do have other questions, please submit them to our support team at contact@strategyforexecs.com, and we will follow up with you afterward. The second question is, what's your beef with business professors and strategy gurus? Is that a real thing?
well, no, I don't have any beef with anyone. I think here's the thing. The problem is that in the book I say that, if you really want to be good on strategy, you should not go to business school. And I truly believe that, right? If you really want to be good on what you do, and if you really want to become the CEO of your company, rather than, going to business school and spending 2 years there, just, deep dive onto your company's own information, right? Read about your own company, analyze its, financial statements, go through the earnings call, talk to your CFO, talk to your, COO. I mean, I think you learn way, more by talking to people in your organization, by, talking to the executives, your peers, and analyzing your company's information, read the contracts with vendors and partners, go to all the key agreements, try to go in all the meetings that you can with key partners and stakeholders and everything. Try to understand everybody's job in the company, and I swear that you're gonna become a better, I would say, better CEO material by starting the company. So here's my premise, right? If you think about good CEOs, I would say that 90%, 99 probably percent of all good CEOs went to business school. There's nothing wrong about it. So I mean, you can be good. Now, if you think about your most admired CEOs, if you think about like the CEOs that everybody, really look up to, they didn't go to business school, right? Jack Welch, Steve Jobs, Elon Musk. I mean, those guys, they didn't go to business school. And, If you go and check the book Outsiders by William Thorndike, you'll see like he tracked the best performing CEOs of in the U.S. history, right? And I would say like probably none of them has like a business background, right? They have multiple different backgrounds, but you know, my point is most good CEOs have gone to business school, but almost none of the outliers, you know CEOs, the best CEOs of all time, they never went to business school. You know what they got a master's on their company. A guy like Jack Welch, he would try to understand every single job in his company. He would try to understand every single piece of financial information of his company. That's how he became manager of the century, called named by a Fortune 500 in the last century. So uh, those guys, the guys that you admire, that you look up to, they didn't go to business school. So I don't have any beef with anyone. I'm just saying, because this, and there's a whole business. You got to understand that there's a whole business behind strategy, right? Like the strategy uh, uh, industry moves way more money than many of the industries they serve, right? This is insane. So just the consulting business and the strategy, advice industry, and that includes like also the schools that train consultants, that train, these strategists and business people, and schools and executive training and stuff. And I'm a guy who I have taken these trainings, right? And just as part of my research for this book, I took probably four specializations, right? I took one on finance with the University of Illinois. I took a specialization on strategy and innovation with MIT. Took another program on artificial intelligence. Took the strategy specialization with the Darden School of Business at the University of Virginia. I got the marketing specialization, so I went through these programs. So I probably shouldn't be talking about it, but the more I understand this, the more I read about it, I see that the people that really made an impact, they didn't go to business school. So if you want to really become CEO material, just start your company. That's what I gotta do. And so I have no beef with no one. And with consultants, what I say in the book is that I advise companies to internalize consulting, their consulting needs when it comes to a strategy. You're gonna need consultants for many things, but strategy advice should come from your own people. You should internalize everything related to strategy advice. That's what I'm saying. And I give examples of many organizations that have an internal consulting division, right? And they are their own consultants. I have my own views about consultants, and I would get into it if I had more time. But I don't have any beef with it. I'm just saying what I learn and the things that I believe. So don't go to business school, and don't hire consultants for strategy. Do your own strategy. You should own your strategy. That's my advice.
Well, I guess that's it for now. If you have any other questions, please email us at contact@strategyforexecs.com, and we will make sure to get you the answers you need. Also, please don't forget to share this webinar on your social networks. You can find us on Twitter and LinkedIn as Strategy for Executives, or on our website, strategyforexecs.com. Thank you, everyone, and enjoy the rest of your day.